Okay. So hello everyone. Hope you are doing well. COVID cases are rising. Hope you are all safe and having a good weekend. And today we have a very special guest who we all look up to, and who is somewhat of an idol to every entrepreneur wanting to build a career in financial services. And it gives me such a great pleasure to have her on our platform. It's none other than Radhika Gupta, ma'am, MD and CEO of Edelweiss AMC. Radhika, ma'am, thank you so much for joining us.
Thank you so much for having me, and hope everyone is keeping safe and healthy and COVID free.
Yeah, I hope so too. So for our listeners, Radhika ma'am is a true global personality, having traveled across 4 continents, bagging experience in consulting, asset management, and even entrepreneurship, and now becoming India's one of the youngest CEO. So starting a company managing only 25 lakhs to selling it off at 200 crores, and now becoming the CEO of a company managing more than 50,000 crores. Radhika ma'am has done it all. Now we only have an hour with you. So if we were to go over all your achievement, I think our session would get over in that itself. So I have a lot of questions for you regarding corporate world and finance, but I think we'll stick to our topic of discussion today. So our topic of discussion is nothing but target maturity index fund. So right now we'll just jump right into the Q&A session. So the very first question I have for you is for our listeners who do not know what are target maturity index funds. Can you tell us a little bit about them?
Sure. And maybe I will, and thanks for the very warm introduction. Maybe I will give you context before we go into target maturity funds on debt investing and then target maturity debt funds. So I think all of us, in the financial services world, in 15 years of doing this, I realize we love to make things very, very complex. This is especially true when you try to do fixed income investing, and you hear about rates moving up and down, yields, duration, RBI governor doing this, that. And so I'll tell you a small story that my father told me once. I learned this from my father, and then I'll come to target maturity debt funds. So he was trying to invest some of his surplus money, and he was like, yeah, Apka, there is some medium duration fund, there's some low duration fund, there's some corporate bond fund. He's like, I'm just confused, what will give me some return? He's like, milega kitna or kitne time mein milega? Can you give me a straight answer to these questions? How much will I get and in what period? And I think target maturity fund is a construct that aims to solve these two problems in the context of debt investing. When we are fixed income investors, our background has been FD investors. We take the fixed and fixed incomes very seriously. So we want to invest for a certain period of time, which there's nothing wrong with because we have goals, and we want to earn a yield over that period of time. That's exactly what a target maturity fund does. So the first part of the world is it's got a target maturity. So a target maturity fund, kind of like an FMP or an FD, matures on a certain date. You invest today and you'll get your money back on a certain day. So if it's in April 2026 target maturity fund, that means you as a consumer get your money back on April 2026. And what the fund does is, because it's giving you your money back on April 2026, it's buying bonds today. So if you give me 100 rupees to participate in one of my target maturity funds today, what I will do is buy bonds and hold them till the maturity of the fund. So essentially, all of us are used to buying an FD. Some of us have bought, individual bonds that NBFCs or, corporates issue. A target maturity fund is just buying a collection of these and holding them till maturity. Because it's buying bonds and holding them to maturity, its yield is very, very predictable. That means if I hold the bond or the product till maturity, regardless of what RBI does, where interest rates go, I know I'm going to earn my yield with reasonable certainty. So it's a way in a mutual fund structure to mimic your fixed deposit experience by buying bonds and holding them till maturity.
Right. Okay. So are you a strong advocate for passive investing, and do you see that we can sometime we can reach to the level of USA, who is right now has more than 2,200 index fund compared to India, which is only having about 250 passively managed funds.
Okay, so I have a slightly different take on passive funds versus active funds. And I think I can be really unbiased in saying what I am going to say because my business today, I just did the math. It's about 50% active, 50% passive. I don't think many people know this. Because of Bharat Bond, the association of us is passive. I actually think passive versus active is not a great question. For a consumer, I think these are great words that our industry uses. I think consumers should look for products that solve a goal or solve a solution. And they could be active products, they could be passive products. The problem is that we start to believe that all passive is good, all active is bad. None of that is true. There are terrible passive products out there. There are very good active products out there. So I think each product should really be evaluated for the question that when we launch a product, active or passive, we ask, is this solving some problem of a consumer? Now, you could have a passive fund that is managing a very, very obscure index and actually solves no problem for any consumer. It just doesn't help. So that is my take on that. Coming to your second part of the question, I do think in the fixed income category, that said, I think passive can be a very powerful construct. While in equities, the verdict on alpha versus non-alpha is yet to be out. I think in fixed income, passive in the Indian context does two, three things. One is it gives liquidity, and you want your fixed income investments to be liquid. Secondly, I think, and in light of kind of everything that's happened with credit funds over the last 2 years, passive gives a lot of transparency in a passive fund portfolio. Like in an FMP, in the old school FMP, which was kind of like a target maturity fund, once you invested, you actually had no idea what was going to happen. There was no index yield, there was no portfolio, nothing was available monthly. In a passive fund, everything's available. So there's a lot more transparency. And I think there is low cost. Low cost may or may not matter in active because there's an opportunity to generate alpha. But in fixed income, as India has gone from a country of 15% rates 20 years ago to now 1 or 4, 5% rates, actually costs matter. So I think passive is a movement that will grow. But I think consumers need to evaluate products on their individual merits. And yes, I continue to be very excited, especially about the passive fixed income space.
Right. Okay. So you talked a little bit about Bharat Bond. So coming to the topic of discussion of the product we are talking about today, can you tell us a little bit about what is the difference in Bharat Bond and the SDL Nifty Index Fund which we are talking about today?
Sure. So I think firstly, the product that we're talking about has a terribly long name, and that's just SEBI guidelines. But the good thing about the name is if I explain each line of the name of the product, the whole product, you can actually understand the product in just the title, which is one of the things that we're trying to do. So Bharat Bond in itself became a very successful program. And I believe the reason Bharat Bond succeeded was one, the target maturity structure worked for people. We have about 40,000 people a month logging into a website called bharatbond.in. And all they see on bharatbond.in is the yield of different maturities of Bharat Bond. And one day, if the website is down for an hour, we get floods of complaints just because of the transparency. So I think the target maturity structure worked. Now, Bharat Bond was focused on a basket of only public sector companies. We decided that it's also important to widen the universe beyond public sector companies. So if you look at the first part of the name, it says PSU and SDL. So the new fund is approximately 50% AAA PSU, like Bharat Bond. It has also got 50% state development loans. State development loans, if people are less familiar, are basically loans. This is an RBI program, just like the government borrows, and we know GSEC for its borrowing needs. States borrow for their own borrowing needs, and that is what SDL is. SDL is sovereign in rating like GSEC. The reason we chose to do SDL, by the way, is usually if you look at different yields, GSEC is first. GSEC gives you the lowest rate of return because it's the safest. Then SDL, and then uske upar AAA PSU. Right now, because of the quantity that states are borrowing, SDLs are actually giving you a better rate of return than PSUs. It's not because anything is wrong with them. It's just because of the supply-demand dynamics of SDL versus PSU. So just coming back to this, Bharat Bond was AAA PSU. This is AAA PSU plus SDL. So similar credit quality, in fact, better credit quality than Bharat Bond. This particular product is maturing in 2026. Bharat Bond, we have 4 maturities, 23, 25, 29, 30 and 31, sorry. We've done 26 right now. We will definitely do more maturities as market demand picks up. And the other difference with versus Bharat Bond is this is an index fund. That was an ETF. That was an ETF because it was a government mandate program, but we also created a fund of funds. One of the challenges that we've noticed consumers have with ETFs is you need to open a demat account, the challenges of trading on the exchange. We just said we'd migrate to a simple index fund format, which is what we've done with our equity passives offerings also. So that's essentially what it is. Target maturity structure like Bharat Bond, 2026 maturity, but AAA PSU and SDL.
Okay. So, ma'am, you mentioned that in comparison to PSU and GSECs, SDLs are much more safer and they have better quality.
So let me come back to this again. So let's just look, and by the way, all the instruments we're talking about here, GSEC, AAA, PSU, SDL are very high credit quality instruments. Now, let's just be a little more nuanced around this. Maybe I can explain that again. So GSEC, as I said, is the borrowing program of the government of India. It's an RBI-backed program. AAA PSU companies are companies that are majority owned by government of India. And of course, AAA means highest rated. Just like there is GSEC for the government, states also do expenditure. They also do infrastructure development. They have various kinds of expenditure. To fund that expenditure, and these days, because of the push on infrastructure, that expenditure is high, they also borrow through a program called SDL, which is State Development Loans. So this is the GSEC equivalent of states. It's also an RBI-backed program. A lot of people ask me that, okay, PSUs, you say AAA rating. What is the rating of these SDLs? The rating of these SDLs, like GSEC, is sovereign. Today, for a sovereign rating, however, SDLs are giving you a better yield than they usually would just because there are so many SDLs in the market. So from a risk return perspective for a consumer is actually doing is getting a great deal by investing in a combination of PSU plus SDL versus pure PSU, because SDLs are giving you a better yield than PSU, even though they have a higher rating.
Right. Okay. So, how predictable would you say are the returns if the units are held till maturity, since the investments are only in AAA and SDLs?
Very predictable, I would say. I think AAA PSUs have never historically had default issues. In fact, they don't have downgrade issues. SDLs are a sovereign-backed program, and I think the beauty of the target maturity structure is that if you do hold till maturity, you do realize your yield. We actually did a small comparison, and now as the Bharat Bond program is maturing, we have more data about this. I don't think I've shared this before. The 2023 Bharat Bond is going to come up for maturity in about a year and a half. And we looked at the index yield of that, which is kind of what was committed at at the beginning, and what the realized yield of the portfolio is so far. The portfolio is actually marginally ahead of the index. So we are very confident that that target maturity structure is basically delivering what it's promised. And I think 2023 will be the first example of investors actually realizing, hey, this was promised, okay, it was delivered.
Right. So actually, I had this question. I think a lot of other audience also might have it, because not a lot of people know what exactly are the debt index funds tracking. So like we talk about the Nifty ETFs, we can go ahead and go onto the exchanges and we can buy Nifty Bs. And we know that Nifty Bs is going to be tracking the Nifty itself, that is the market index. So what are the debt index funds actually tracking?
Yeah, that's a great question. So each debt index fund tracks a particular index. So for instance, and it's very important as an investor to pay attention to what that index is. So if you look at the Bharat Bond indices, the Bharat Bond indices track the Nifty. It's called Nifty not because it's equity, because all NSE indices are called Nifty. It tracks the Nifty Bharat Bond target maturity indices. The SDL PSU fund tracks the Nifty SDL PSU 2026 index. All these indices are and indices are not made by the asset management company. They are made by an independent index provider, which is either someone like NSCI, MSCI, NSE, BSE, CRISIL, etc. What you must do before investing in any of these target maturity funds is study the index. And all index data is available not just from the AMC, but it's available independently on the NSE's website. So if you go to NSE and you go to fixed income indices, they will have target maturity indices, and you'll see all this Bharat Bond and these indices. Every day you can go see the index weights. Every day you can go see the index yield if there is a change in the index that's available. So it's very, very important to see the index, because the index tells you ultimately, just like when you invest in an active debt fund, you care about the portfolio, right? That's the most important thing. Here, you have to care about the index. It's also important, as passive is growing, to develop a nuanced understanding of passive, you have to understand how the index is made and constructed.
Right, that was the exact, like as an investor, I should always know what exactly is my fund tracking, where is my money going.
Yeah.
So, coming to the return point of view, what are the post-tax returns that we can, as an investor expect during the period of the maturity?
Sure. So, okay. So the yields change, and I'll talk a little bit about taxation. So I remember when we launched this, and yields have significantly changed since then, but let me at least go through the launch numbers and I'll tell you what current is. So at the time when we launched this NFO about a month ago, the pre-tax yields were around 6.3, 6.4K around in the, so that was pre-tax, pre-expenses. You take out expenses, these things are taxed like debt mutual funds, which means that they have indexation after 3 years. Effectively, that means if the rate of inflation is 4 and you earn 6 post expenses, then 6 minus 4, 2% pay, you pay 20 basis points, which is about 40 basis points. Around the NFO, I think the post-tax yield was around 5.9 to 6%. Today, I suspect it's closer to 5.6, 5.7%, which is a very healthy rate of post-tax returns. I think one of the things that's not appreciated enough about debt mutual funds is the tremendous tax advantage that they carry versus traditional debt instruments, including FDs, if you are a full tax investor. So 5.6 to 5.7, I think, is today the right range.
Okay. So, ma'am, you mentioned about the liquidity of the fund. So, anytime, when I'm looking towards debt, I would always look at my liquidity. So, is there a specific lock-in which I need to have for investing into the fund?
Okay, so this is a good question. There are two parts to this. One is there's no lock-in. There's an exit load under 1 month just to ensure that money doesn't move in and out. Essentially, there is no lock-in. So these are liquid instruments. AAA PSUs are super liquid. SDLs are liquid. By the way, the reason we didn't do 100% SDL portfolio here is we felt that, and we've got a lot of experience now doing debt passives with Bharat Bond. We see flows. Last year, we processed in our AMC 30,000 crores of gross inflows, which is a massive number. So we have experience trading large volumes here. SDL plus PSU gives you a nice combination of liquidity. From a consumer's point of view, however, just because there's only a 1 month exit load does not mean this is a 1 month investment. The 2026 product is a good 5-year investment. It's a good 3-year investment also. We did a little scenario analysis that given where interest rates are today, even if rates were to move up 50 basis points to 1%, and this data is on our website, after 3 years, if rates moved up even 1%, which is a lot, you still would make better money than investing in a pure 3-year product today. So for a 3 to 5 year horizon, it's a great product. For a 1-2 year horizon, it's not the right product. That's very important to keep in mind. So don't just look at the exit load as a determinant of time horizon.
Right. So you talked a little bit about interest rates and yield spiking. So what are the repercussions if the bond yields were to go up? As an investor, I always think, oh, the bond yields are going up. What would happen to my product? So what is the
Absolutely.
correlation between the product we're talking about, which is Nifty, PSU bond, STL index fund, and the bond yields?
Okay, so very good question. I think, in fixed income, we always highlight two risks. One is credit risk and one is interest rate risk. Obviously, credit risk in a product like this is less relevant. Interest rate risk. So yes, in general, in a fixed income product, when rates go up, prices go down. So that causes a hit to your NAV. This is true in this product as well. If there is a short-term rise in interest rates, it will hit the NAV. However, that is the beauty of the target maturity structure. In a target maturity structure, if I'm buying bonds and just holding them till maturity, it's like if I bought a bond today individually, 100 rupees principal, 5% a year interest, and it was a 5-year bond. 5 years later, as long as the person who I bought the bond from doesn't default, I am going to get 25 rupees of interest and 100 rupees of principal, regardless of what happens to rates. Now imagine me holding a basket of those bonds. The same thing will happen. However, in the middle of those 5 years, if interest rates move up from 5% to 6%, my bonds temporarily become less valuable. So my NAV will take a hit, which is why if you are a hold to maturity investor, interest rates should not bother you. If you are a short-term investor, you could be subject to interest rates movements. If interest rates fall, and by the way, in this product, after the NFO, interest rates have fallen faster than expected, the NAVs will be better. So you will have interim movements in NAVs. That's very important to keep in mind. Note, however, in a target maturity structure, because you start with a 4-year duration and it keeps gradually coming down, the volatility and the correlation with interest rates will come down over time because the duration comes down over time.
Right. So, do you think that was happening the case in the last 2 months itself? I think a lot of the debt funds were taking a hit. I think that was mainly due to the yields rising.
Yes, and I think in the last 2 months, as February and March have been very sharp for interest rate movements. And I get a lot of messages on social media saying, ma'am, why is my debt fund down? Why is my short-term fund down, etc., etc., etc. And it's not about Bharat Bond or index funds. And yes, it is rising interest rates affecting your debt fund. Again, I go back to my simple example because I just think, in an equity fund, if you lose 10%, you are very comfortable with it because we understand equity risk. Fixed income risk is not understood. So again, imagine I'm the person who has a bond with 100 rupees principal and I have a 5% interest over 5 years. Suddenly interest rates rise from 5 to 6%. Obviously, people want my bond less. So bond prices will go down. That is what has happened to your debt funds in the last few months. The way to end, if you were holding GSEC funds or longer maturity funds. So again, take my example. I have two bonds. One's a bond where I have 5 years of payments. One's a bond where I have 1 year of payments. The bond where I had 1 year of payments, if interest rates fell, it would be less affected than the bond where I had 5 years of payments, just because there were many more payments. So bonds with higher duration or funds with higher duration definitely have a higher impact when interest rates go up. So that is what has happened. So if you were invested in a GSEC fund or a long duration fund over the last 2 months, you probably are feeling very upset. Okay, what happened to my fund NAVs? This is natural and part of the process. That is why we say in fixed income investing, the single best thing you can do, and there is one thing to keep in mind, is match your time horizon to the maturity of the fund to prevent this from happening.
Right. So right now, I believe we are having two. Are we having two types of maturity in the Edelweiss Nifty bond?
We have one series today, 2026, and we will be coming out with other series later.
Okay. Coming to the fact that this is a mutual fund as compared to a ETF, so there will be some kind of expense ratio involved in this fund. So what is the expense ratio we are looking for?
Okay, so this fund, and I think one of the nice benefits of index funds is the low cost they come with. This is 30 basis points in the regular plan and 15 basis points in the direct plan. Again, this is some of the cheapest sort of expense ratios you'd find in debt funds, which are probably 50 bips to 1%.
Right. For our listeners who do not know exactly what basis point means, could you tell us in percentage?
0.3% and 0.15%.
Right, exactly. So as an investor, I also wonder, can I pledge my holding towards the mutual fund and maybe look to, because this is definitely going to be a long-term investment. It's not going to be a short-term investment. So I'm going to be looking towards investing my funds over the entire course of the maturity. So can I pledge my holding and invest that money into different assets?
You should be able to pledge your holdings in Bharat Bond. Bharat Bond's rules or the SDL PSU don't work differently from any debt mutual fund. So really what applies to any debt mutual fund in terms of rules will apply to Bharat Bond.
Okay. So this would be a missed opportunity if I don't talk to you about equities.
Yes.
So I think with that, our discussion for the PSU, the SDL bond should be over. We'll let the audience also ask some questions if they have any questions for you regarding the product itself. But I would like to pose you some questions regarding equity as well. So, should a retail investor consider exposure towards international equity? What is your take on that?
So I've got many questions on this. And I've been investing in international equities as an Indian since 2011, running the business since 2017. And in the last 2-3 years, I've never got so many questions as I have on this topic. So let me give you a few points here. The answer is yes, but yes, thoughtfully. And let me just outline this. So there are reasons why a retail investor should invest, and there are reasons why a retail investor should not invest. The right reasons to invest abroad are: one, diversification. Different asset classes and different countries perform well at different times. There are times when China is the best performing market. There are times when India is the best performing market. There are times when US is the best performing market. You have to take advantage of this in your portfolio. Just like we say in India, don't put all your eggs in equity, put them in debt and gold and etc. etc. Same applies for countries. That is the number one reason why you should invest abroad. The second reason you should invest abroad is that you get access to many ideas that are not available in India because of the stage of our economy. So 75% of tech businesses come from the US. All big tech, I mean, there are probably 100 great tech companies sitting out there in the US that you have no access to, because in India, tech is Infy, Wipro, and largely IT services. That's a very good reason to do this. So access to companies, same thing with healthcare research. The third reason to invest abroad is currency depreciation. The rupee depreciates at about 4% a year. You may have expenses in dollars. You may want to build assets in dollars. This is a good way to hedge against the rupee. Now, when you're investing abroad, the risk is that because the last 2 years of international fund returns have been so good, I think a lot of people look to invest abroad just because of the returns. That's why there are like 7 AMCs launching NASDAQ funds today. I mean, why did the NASDAQ suddenly become so popular? It's not even the best US index. That's the S&P 500, right? So you should not invest abroad just because of recent returns. Secondly, and I run a fund called Edelweiss Greater China Fund that I think has been incredibly popular over the last year. A few weeks ago, someone writes to me on Twitter, will it take 6 months or 12 months for Edelweiss Greater China Fund to deliver a 15% return? It was down 10% in the last 1 month. And this was an investor query, and I was worried. And what I want to tell you is when you invest in international equity, remember it is equity first. चाहे वो ब्राजील की equity हो, India की equity हो, US की equity हो, you have to invest like an equity investor. So long-term time horizon, SIP focused investing, being prepared for volatility, withstanding that, all that is necessary. And believe me, it's much harder to see a 20% correction in a US or China fund than an India fund, because in India, you understand what's going on. Your friends understand what's going on. There's the economy you understand. You follow the politics. China mein jaake kuch hoga na, and you will have no idea what's going on, and you'll suddenly feel very uncomfortable. So that's why it's important to be very thoughtful in investing and invest for the right reasons. So my short answer is you must do it. You must do it for the right reasons. And you must do it after your basic Indian equity allocation is complete.
Okay, thank you so much. So you talked about these ETFs which are investing, and we have the Nasdaq tracking index funds, and then we are also having the Edelweiss Greater Offshore China Fund which you talked about. So would you have the exposure towards these international companies through stocks or through ETFs?
Okay, so there are 3 broad ways to do exposure to international funds. One is directly. Secondly is through index funds or ETFs. And thirdly is through actively managed offshore funds. Okay. And let me talk a little bit about the merits of all 3. And I must tell you, I come with a terrible bias because I'm an MF CEO. So you know where my answer will lead you. But that said, so I have a bias for doing things either via the fund route. And fund could be index fund or actively managed fund. I happen to run largely actively managed fund and some index funds. So we can talk about the nuance there. The reason I don't want to do this directly is because direct investing, one, has withholding tax. Secondly, it is difficult. It is hard enough to manage a good portfolio of 20 to 25 companies sitting in India. It is really hard to do abroad. You might be able to do US, any market besides US, and you might be able to do US because you think I know Berkshire and Hathaway, Berkshire and Tesla, etc., and I know the big companies. Let me tell you, even in tech investing, and we run probably one of the largest tech funds in the country, FANG is not all there is to tech investing. There's a much wider range of companies you haven't heard that are doing path-breaking stuff in tech. It's a very actively managed business. In fact, we don't run it ourselves as a professional asset manager. We partner with JP Morgan, which is one of the largest asset managers in the world to do. US is tough. Try doing this for Brazilian or Chinese equities. It is very, very, very tough to do. So that's my one reason. Whether to choose index funds or actively managed funds, I go back to my active versus passive point. I think you have to evaluate the fund on its merit. I've seen index funds that invest in 10, 12 stocks and are not great index funds. I've seen active funds that, not just ours, even US funds by some of our competitors, that do a great job outperforming the benchmarks and have very good quality portfolios. I've seen our own China fund. So I think that is a call that you can individually take.
Right. Okay. So, coming towards more questions regarding your personal take, and anyone who's following you, he or she would know that you talk a lot about investing in BAFs, balanced advantage funds. So you say that over 60% of your funds are allocated towards BAFs. So can you give us some more insights on how exactly do they pose an edge over other funds?
Okay. So I think for the audience quickly, and yeah, I am known as like the BAF fan. And it's true, and I'll tell you why. I'll give you statistics in a bit. I think BAF is like the old school Indian thali. It's everything that you want on one plate, and it just makes life easy rather than choosing from a very complex menu of things to eat. It has equity, it has fixed income, and it allocates between equity and fixed income depending on market conditions. As our own ad said, BAF is like a good Indian kabaddi player. When markets, when it's the time to fight, it goes out and increases equity exposure, and when it's the time to step back, it is defensive. That's why I like BAFs. So I think they solved my problem. I consider myself a fairly market-savvy professional. But I also don't have a lot of time. And so people keep asking me, ma'am, how was your portfolio last year? How was it this year? Well, it's been in BAFs all through this year. Now, let me give you a statistic that I discovered yesterday. I do SIPs into BAF. I'm a salaried professional, so I have salaried income. And as I said, a large part goes into BAF. So I do a monthly SIP into BAF. Usme meri kuch mehnat nahi jati. It just goes out every month. In the last 5 years of doing my SIP in BAF has done a 15% CAGR over 5 years when markets have done a 14% CAGR. So I am very happy. I've actually earned a 15% rate of return. I've beaten markets without ever trying to beat markets. I've done no effort whatsoever. And in a period like March 2020, when markets fell 30% and we felt COVID was going to drive the world crazy, and we were worried about food riots. I mean, we forget what March 2020 was like. Markets were down 30%. My little BAF was down 13%. So I didn't have a need for panic. So that's why I'm such a fan of this category, because I believe the average Indian investor's need is decent returns. I want to beat my FD. I'm aspirational. I want to do well. But I also don't want heart attacks in life. There are enough reasons in this country to have problems in life that investments should pose one more problem. So I think BAF solves that need. It's not a very glamorous way to solve that need. So if I tell my HNI friends that I'm doing BAF, they find it very boring. You're a markets professional. You should be trading stocks and having an active bond portfolio. Bas itna hi kar rahi ho types. But it actually works for me.
Right. I think you should do whatever works for you the best. And you talked about this 15% CAGR. So over here, you're talking about the Edelweiss fund?
Yes.
Okay.
I mean, you
over the
can
past.
check this out on our website. So, by the way, we just released a new website that's in beta. So, if you go into the new solutions pages on our website, you get a lot of really rich data. So, you can see BAF, you can see its historical holdings, you can see if I did an SIP, how was it in 5 years? You can look at regular versus direct, you can do rolling returns, you can have lots of fun. So, go check out edelweissmf.com for this. You can see how
Right.
it did versus gold, etc.
We'll be linking the website for anyone who wants to go onto the website. And people who are going to be watching on YouTube, you can find it in the description. And some audience are also asking some questions. Okay. So right now, I don't see any specific question for you. So I would like to ask you some questions. This would be an opportunity missed if I don't ask you questions regarding entrepreneurs. So if it were not Edelweiss, who else would you go for?
Okay. Now you're talking about from the point of view of selling a company too, or from the point of view of sort of asset management? I just want to understand the question.
Yeah, I'm talking about the asset management.
Okay, so I think some of our peers are doing very good stuff out there. I have, and I won't name MC, or maybe I will. I have a bias towards mid-sized guys. I think there are some mid-sized AMCs doing incredible work out there. I think the guys at Canara Robeco do very, very good work. They are very quiet, but I think they run really high quality portfolios. I think Neil Parekh and the guys at Parag Parekh do super work out there. I think the guys at Invesco are building a great team. So I think there are lots of guys, and some of these guys, by the way, so I do about 70% of my investments with Edelweiss. 30% is outside. And I definitely do have and have had investments in some of these AMCs, and I'm very, very happy with them.
Okay. So
I mean, if there's one thing I would tell the audience, I would say give more mid-sized AMCs a chance. Having gone through a long journey in this business, it is a very size-focused business. And, the world makes you feel like just because someone has 10, 20,000 crores of size in a scheme, they must be doing the right thing. You should definitely look at some of the mid-sized boutiques doing a lot of very good work.
right. So which sectors do you think are currently having tailwinds?
Okay, which sectors do I think are current? So we tend to be a very quality focused AMC. In terms of our stock selection choices, we have had a liking for industrials. We think, by the way, banking and financial services is getting out of its tough times. So you will see better opportunities from a banking point of view. And we are excited about consumer because we think even if India goes into an extended lockdown, and look, I'm sitting in a containment zone doing this call right now. I think consumer companies will continue to benefit. Consumer doesn't mean just FMCG. Consumer means anything that is focused on a consumption opportunity. Could be healthcare, could be consumption, but anything that is tapping consumption.
So Edelweiss has any product in this space which you're talking about?
So hashtag coming soon. We will do something on the financial services side soon. We did something on the healthcare side that I think became very popular. We did a healthcare index fund that is, I think, India's only Indo-global healthcare index fund. And in the index, and that product has done well and been very popular. And we will do a couple of other things on this side, on the thematic side.
Right. Okay.
There's another interesting thing we'll do on the thematic side. I can't talk about it yet, but one of the funds that you should track from us, which was launched 3 years ago, it's a closed-ended fund. It's called Edelweiss Maiden Opportunities Fund. It's the only fund that was investing in IPOs and recently listed companies, and it's done extraordinarily well. It's a very process-driven fund, so we'll give you some updates on that also very soon.
Okay, so maybe we can have you again on the platform. So any book you would recommend to the other investors, or any personal growth tips which you have for other investors?
Okay, so personal growth is a tricky one. But I would say and you guys will laugh, I don't read many finance books. So people assume that when they know me that I will read a lot of finance books, and I will give you 1 or 2 recommendations, but I don't read many. I actually read fiction most of the time. And if any of you know me, I like poetry. So I read old Urdu poetry, and my reading tends to be that, and that is reflective in my writing. I do think, that said, one book that is very good for investors is Nudge. It's a Richard Thaler book, and it talks about, see, everyone talks about the mistakes investors make and the biases investors have and all that. Lekin kare kya uska? How do we solve that? So Nudge gives you very practical solutions that you can implement in your day-to-day life. I do a talk on Nudge also. So I think that's one book I definitely recommend to you. I also think, by the way, and I'm going to do a small Edelweiss plug, that a lot of people don't like reading big finance books. We do very good book summaries of finance books, which are on our website. So if you go to the insights section, there is a book summary section, and there's no product sale. It's just simple, good book summaries. If you're an investor with us, you probably receive them in your mail. Do check those out. They're also in audio format. So there is a podcast called Edelweiss Money Connect. So it talks about investing in lessons from Ramayana. It talks about Kabir Doha. So lots of interesting story-oriented content that you can pick up from us.
Right. I was just watching the recent interview of yours where you talked about how you are teaching investors taking hints from the Ramayana, how exactly you can grow, and it teaches you a lot about patience, and it gives you a lot of insights into actual investing. So I think Ayush has a question for you.
Yes, good afternoon, ma'am. I just had one small question for you. Now, since you are from Penn University and you are at the position of CEO at Edelweiss, now I am starting to like these demergers and special situations a lot. And there's a study from your university that has highlighted that if someone is to just invest in special situations and demergers, more specifically spin-offs, he will make 10% more than investing in an index. So I just wanted to ask and put in a quick question, like, is there any plan for the for Edelweiss to in the future launch a fund or a fund of fund which will just invest in spin-offs?
Great question. So yes and no. So yes, India has, there is a whole, and in fact, the fund I worked at in the US had a whole category. I mean, it had a whole spin-off unit called merger arbitrage. So there are a lot of these broadly what I call event arbitrage strategies that are very profitable. They include mergers, they include demergers, they include open offers, buybacks, etc. Unfortunately, there are not enough of these coming at all points in time to be able to run a mutual fund vehicle effectively. We actually do quite a bit of this stuff as debt plus kind of trades. We do some of these ideas in our balanced advantage fund, and that's why our returns tend to be better than fixed income in the debt portion. We do some of them in our AIF platforms. In fact, we run a couple of dedicated funds there. So we do it there. I talked about what we do in maiden opportunities, but to do only this in a full-fledged fund, there isn't enough opportunity where I could not be sitting on cash. I would end up sitting on a lot of cash. But it's a space we work on and track very, very actively.
Okay, thank you, ma'am. I just asked because in the US there are special websites where they give details of what all special situations are happening, and in India not even such websites are there. So taking this as an opportunity, I thought why not ask you if there would be in the future such a fund which would be coming up. So it would be a very good fund for a retail investor like me to invest in. So
no, it's a very good idea. And I think the day I think there is enough capacity, because I never want to take investor money and sit on cash and not be able to deploy it. Any idea you deploy has to have enough market size. In fact, that's why we did the IPO fund first in a closed-ended format, because we also wanted to see, can we do this in a limited format without huge scale and see if this will go well? And then, we can think about what to extend it. So there are a lot of these interesting sort of global ideas that we are trying to do, piloting them and then hopefully expanding them.
Thank you, ma'am.
Okay, so I just have one final question for you, and then maybe we audience have some questions posed to you. Do you have any advice for our startup, what we are doing over here?
I think you're doing great work, and the only thing I would say is lage raho. I think there is so much that needs to be done by the way of educating investors and doing it in a nuanced way. So I really like that we had a very focused conversation on target maturity funds. And I think one of the things that will happen in India, and Ayush asked this question about special situations, but so many new categories of funds, so many new categories of instruments, so many types of investing will come out. And to have conversations like this, so that, you know, even if you think index fund investing is simple, there are nuances to it. So I think keep taking parts of these new investing spaces and educate investors. I think that's a great service you guys are doing.
Thank you so much, ma'am.
Thank you,
I
ma'am.
Okay, great. So I think we have about more 10 minutes with you. We've already taken an hour. So I'll just let the audience post some questions if they have from you. And I'm seeing right now some questions over here. So the first question which I would like to pose to you is, what do you think about the 100 minus age percentage should be invested in equity?
I don't buy it. I think it's a good. I'll tell you why. It has gone terribly wrong for me, because I think so when I was 25, and I've told this story publicly, I followed 100 minus age, and I invested 75-80% of my wealth in equities. Actually, no, it was 90%. And it was a disaster for me, because in 2008, when markets fell, my income fell by half because I worked for an asset management company. My ESOPs fell by half, my fund returns fell by half, and my equity portfolio fell by half. And by the way, my husband is in the same profession, so just multiply that by two. I think every individual at different ages, just two 25-year-olds don't have the same set of circumstances. You could have a 25-year-old who comes from a very, very wealthy family with no liabilities, who doesn't need to buy a house, and, you know, can afford to take risk. You could have a 25-year-old who's paying off college loans and needs to support a family of six. Their circumstances are not the same. My father is 30 years older than me, but because his two children are doing perfectly well, he's got a government pension. My mother is a school educator. He has much higher risk appetite than me. I work in financial services, so does my husband. So my risk appetite is much lower. So I think personal finance is very personal. And these can be thumb rules, but you really have to do what works for your situation.
Right, and that is exactly where these debt funds come into.
Exactly. And that
And
is why I think debt is a critical part of your portfolio.
right. Okay, so what next do we have? We have a question from Mr. Akash. He says, how do you start a portfolio management company in India?
So it's actually not as hard as you think it is, the actual starting. We started this in 2009, and I was 24 then, and we had never lived in India. But credit to SEBI, we filed an application. We actually managed to get our license in 21 days at that point in time. So for everyone who says India is bureaucratic, etc., as a startup, we managed to do this fairly quickly. You need about 2 crores of capital. That's a lot of capital to put in. I remember it being a lot of capital back then. The harder thing is acquiring customers. So you'll have the company set up, you'll get the license, then you need to go out and have a strategy to convince customers to give you money. So I think the setup in itself is not very difficult.
Right, and you managed to make big out of it, right?
Yeah, but with a lot of time. So as I said, it started with 25 lakhs. A year later, it was 2 crores. So give it time. I mean, if you're going down this route of starting your own, financial services and asset management takes time. I mean, I have seen my first 3 months in the mutual fund business where, you know, we were not, forget raising assets, we were losing about 50, 100 crores of equity assets a month. So things take time in this business.
Right. So there's a question from Mr. Mridul. He says that where exactly can I find more details regarding to debt mutual fund segment?
So some of it, as I said, if you look at the investor education pages of our website, new website, there is, I think some of it is content like this. And if there's any specific ideas on things you'd like to know about the debt fund segment and we can put out as content, we'd be very happy to.
Okay.
Definitely, I would recommend you check out the insights content on our website.
Right. We'll be linking that as well in the description. So Mr. Gautam says that I wanted to invest in a fund that takes part in the upcoming biological sector. So does Edelweiss have something upcoming in that?
So we have a healthcare fund, and that will have a component of biologics, not just India and US biologics. So you can check out its Edelweiss MSCI Indo-US Healthcare Fund.
Okay, great. So, Mr. Hemal says, what happens to stock markets if a mini lockdown happens in Maharashtra? Which sector allocation would you suggest all happen?
Okay, so I'm sitting in a containment zone, guys, and things in Maharashtra are extremely bad right now. I don't know if a lockdown will happen in Maharashtra. I also don't know how long the lockdown could be and whether it will be an economic lockdown or just a social lockdown, because there is a question. So it is very hard to say, which sector allocation will you suggest if a fall happens, because you don't know if a fall is going to happen, right? Markets work on expectations. If it's a 15-day lockdown that doesn't affect business, chances are it's not going to affect markets in a big way. In general, our bias, as I said, has been towards quality. In the last few months, you've seen a rally in cyclicals and some of the less high quality names, and I think that has reverted a little bit. So we look at companies for a much longer term horizon, and coincidentally, I think quality will tend to do well. If there is any kind of turbulence, quality companies do well in a period of turbulence, but it's very hard to predict lockdowns and their impact on markets. Very, very hard.
Right. So I think we have any more questions. If the audience has any other questions relating to SDL, what you can do is I'm going to be linking our email address into the description, and you can go over here and you can send us an email, and maybe we can reach out to Radhika ma'am, and we can get some answers to you regarding the product itself. But with that, I think we can end the session. So thank you so much, Radhika ma'am, for coming onto the platform and giving your time, and we hope to do it again sometime, because I am having so many other questions as well for regarding to corporate world finance, and 1 hour with you is not going to do justice to all those questions.
So thank you so much, guys. I'm very happy to do this. Very happy to kind of continue connecting and doing this again. I see some questions on the chat window on other funds. So if I haven't answered anything, sorry, it was just lack of time. And as I said, our website we literally just released a new website Friday night, so it has a lot of information out there.
Right. So if you guys have any other question, you can send it to us on our email, and do go to the website and check out what exactly Radhika ma'am is saying. Okay. Thank you so much, ma'am,
Thank you.
and hope to have you again.